Welcome back to Investing Talk Podcast.
Today we're looking at security matters.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
So let's do it. And I think it's really important to frame this one correctly right from the start.
Absolutely. This is a pure early-stage tech story. It's
Yeah.
pre-commercialization, really.
Right. So when we're talking about its value, we're not looking at a P&L.
Not at all. The value right now is entirely in its intellectual property and, its strategic position in the market. We are miles away from talking about earnings power.
Okay, so let's unpack that because the whole bull case hangs on this core technology.
Yeah.
What is this moat they have that's supposed to be so special?
It's actually fascinating.
It's not just another software tag.
No, not at all. They have this proprietary submolecular marker technology.
Submolecular.
Yeah. So just picture an invisible chemical signature that they embed directly into a material.
Into the plastic itself or the fabric? Or
Exactly. Into the fiber of a luxury handbag or the coating on a pill.
Yeah.
And then that physical marker is paired with a blockchain stack.
Creating a digital twin.
A completely secure digital twin. That's the key.
I see. I hadn't quite grasped that before. I mean, with a QR code, you can just peel it off, stick it on a fake.
Of course.
But if you mark the material itself at a level you can't even see, well, the product literally becomes the authentication token.
That is the crucial differentiator. You get this tamper-resistant end-to-end traceability, all the way from raw material to the final product.
And competitors who are just using software or, a tag on the outside, they just can't offer that.
They can't, especially not for things like plastics that get recycled and broken down over and over.
Yeah.
You can't guarantee that integrity.
So what are the industries where this kind of deep-level security is becoming essential?
Well, the obvious one is luxury goods for fighting counterfeits. That's a huge market. In pharmaceuticals, where safety and origin standards are always getting tighter. But the really big one, the major tailwind pushing this whole narrative.
It has to be the circular economy, ESG.
Exactly. It's that massive global push for ESG compliance.
Right, because it's not enough anymore for a company to just say it uses recycled material.
They have to prove it. For regulators, for consumers, for everyone. This tech lets them actually audit and verify where their materials came from at the molecular level.
And that would make them, well, pretty sticky B2B infrastructure if it gets adopted.
Very sticky. The switching costs, once you're integrated, would be enormous.
Okay, that's the long-term vision, and it sounds powerful. But we have to talk about the reality right now because the financials, they're painful to look at.
They are. And it's a stark reminder that this is a development stage company. The P&L strength is, well, it's non-existent.
So give us the hard numbers. How bad is it?
The figures are, let's say, unambiguous. You've got basically zero recognized sales. For the full year, revenue is hovering right around $0. And with all the R&D spending, the net income is, deeply negative. The net loss for the year was about $31 million.
And that burn rate is actually picking up, right?
It is. The last 6 months were worse, around $23.5 million in losses. It's a huge investment for a company this size.
Which brings us to the earnings per share, which looks, frankly, terrifying. It's something like negative $7,000 or $8,000 per share. How is that number even possible?
That's a classic sign of a microcap that's gone through some reverse splits, probably post-SPAC.
Okay.
You're taking that huge $31 million loss and dividing it by a really, really small number of shares. It just amplifies the per-share metric into something that looks kind of absurd.
So it's more about the share structure than the absolute cash burn. That's important context.
It is.
And what about their financial health? Are they loaded with debt?
That's the interesting part. They've relied almost entirely on issuing equity. So capital from the SPAC, other offerings, there's virtually no meaningful debt on the books.
Okay, so the big risk isn't a bank calling in a loan. The main risk is just dilution. They have to keep selling more stock to fund the dream until revenue starts flowing.
Dilution is the name of the game here. But, and this is the critical part of this section, the entire market cap is down around, what, $5 to $7 million?
Tiny.
The market already knows all this. The extreme skepticism, the cash burn, the zero revenue.
Yeah.
It's all priced in. The downside from here, based on current performance, is arguably pretty limited.
And that's the pivot point, isn't it? That's where you go from the bear case to the potential blue sky scenario.
Exactly. It all comes down to operating leverage.
Okay, explain that. They've spent all this money on R&D, building out the tech.
Right. They've paid the huge fixed cost. They've built the core marker, the readers, the software stack. That's where all those losses came from.
So the expensive machine is built. Now they just need to start feeding customers through it.
You've got it. And once that's in place, the cost to serve each new customer, the marginal cost, is incredibly low.
So if they land a big contract, say, with a major plastics recycler,
the revenue from that contract doesn't just cover the tiny cost of the chemical markers. A huge chunk of it goes straight to the bottom line because the big R&D costs are already sunk.
That's what they mean by a high-torque investment. A small change in revenue could cause a massive swing in profitability.
A massive swing. And because the revenue base is literally zero, even a single modest contract win can move the needle in a huge way.
And nobody's expecting it. I mean, there's no real analyst coverage, no consensus estimates.
Expectations are on the floor, so any piece of good news, like a successful pilot converting to a full production contract, would be a complete positive surprise for the market.
Which connects back to that bigger theme we talked about, the push for sustainability, for anti-counterfeiting. That provides a constant tailwind of positive perception.
It does. The world is moving towards technology that can physically prove where things come from. That's not going away.
Okay, let's shift to the technicals and market sentiment, because the price chart here is, it's been a disaster.
A complete disaster. We're talking a one-year drawdown of something like 99.9%.
Wow.
This is the absolute definition of a washed-out microcap. The long downtrend has shaken out pretty much everyone.
Now, what does that mean for someone looking at the chart today? Is there any support?
Well, that recent all-time low, down in the $6 to $7 range, that's now acting as a kind of structural support.
Okay.
For traders who like volatility, seeing a base form above that low is often seen as a pretty clear low-risk entry point. Your downside is defined.
And the potential upside, given the operating leverage, is huge.
Exactly. And you see that speculation in the headlines. You know, these articles talking about jumps of 2,000% at the open or a 40% rebound in one day.
Right. It shows the market sees this as a pure lottery ticket, a bet on a news event, not on current fundamentals.
It's totally event-driven. And because of that, you have to look at who's buying, or in this case, who isn't.
The institutional vacuum.
Right. There's no large institutional accumulation, no big insider buying waves. The stock is just too small and illiquid for most big funds to even touch.
But that vacuum could become an upside lever, couldn't it? Especially with its ESG angle.
Absolutely. The float is tiny. If this company lands one flagship contract, just one, and a few niche ESG or small cap funds decide they need a position,
there wouldn't be enough stock to go around. The price move will be violent.
Extremely violent. There's no institutional selling pressure overhead to absorb that kind of sudden demand.
So that brings us to the most critical part, the next 6 to 24 months. What are the specific events that could make or break this? Let's start with the big risk.
The primary risk is simple: execution and financing.
Can they actually do it?
Exactly. Turning this complex, cool IP into a scaled, sticky product that large companies will actually integrate is incredibly hard. And without revenue, they'll almost certainly need to raise more money.
So more dilution is probably coming.
I think investors have to assume that a capital raise is on the horizon. But you have to weigh that against the upside.
The asymmetry.
Right. If the market cap is only $7 million and they raise $5 million, yes, that's dilution. But if that $5 million gives them the runway to land one foundational contract,
that one contract could re-rate the entire company by multiples, making the dilution a non-issue in the grand scheme of things.
It's a pure risk-reward calculation.
So what are the catalysts we should be watching for? What's the good news we'd need to see?
Okay, number one, new strategic partnerships with major brands. And I don't mean just another pilot. I mean an announcement of a real supply chain integration with a luxury house, a big apparel maker, anyone like that.
Number two would have to be regulation.
For sure.
Yeah.
If traceability rules in, say, pharmaceuticals or food get tighter, and they specifically mandate physical markers because they're tamper-proof, that would be a tectonic shift.
And third?
M&A. This company, with its unique IP, could be a very attractive tuck-in acquisition for a bigger player.
Like a big supply chain software company that wants to add ESG capability overnight.
Exactly. Someone who would find it much cheaper to just buy this IP portfolio than try to build it themselves.
So to wrap it all up, this is a high-torque, almost option-like bet. You're betting on this unique tech becoming critical infrastructure for ESG-driven supply chains.
It's a bet on brilliant execution and future regulations, bought at a valuation that already reflects the fact that today, the business isn't performing.
And the key thing to watch for isn't just the top-line revenue number.
No, it's the transition from pilots to production. How many industrial customers are actually integrated and paying? That's the proof point. That's the signal that the risk is dropping and the thesis is finally starting to play out.
Okay, here's a final thought for you to consider then. If this technology really is the best way to track recycled content, how fast could a new regulation in Europe or the US force industrial giants to rip out their current systems and adopt this one? The speed of regulatory change might be the real wild card here.
If you want more analysis like this, make sure you hit that subscribe button before you go.